Good morning, good afternoon, good evening, ladies and gents, wherever you're joining us from. So thank you for what is the penultimate workshop in the series that we've been running on climate and energy transition finance. And as Nish mentioned, this is the seventh workshop of the series. We started the workshops in September, focusing on the risks in the green hydrogen economy. We subsequently looked at what structures could be used or levers could be used to stimulate the market and demand. We identified a key pinch point on financing capability, rather capacity in the banking and finance system for renewable energy. We looked at how we make the market, as all of you are raising that question time and time again. Yes, we're ready to produce green hydrogen, or we are ready to deploy energy transition projects, but who's buying? That was a fundamental question. We looked at carbon financing in the previous workshops, and now really focusing on the two most important aspects, which is equity capital, and the next workshop, the final workshop of the series, will be on the debt side of things. So thank you for taking out the time today. We have a number of experts in this sector joining us from London. Right, nice and bright and early is Matt Hammond, who's a partner at the Foresight Group. I'll let Matt and all the discussants introduce themselves. Mr. Kishler Mishra, he joins us. Kishler, I take it you're in Dubai, right? If I recall. He's a senior investment officer with AIIB, a leading development finance institution, and hopefully colleagues from IFC and Avada. First sort of opening question to all four of you. From your perspective, India requires $500 billion, $500 billion odd capital investment in the next 4 or 5 years if it has to make the milestone of 500 gigawatts under deployment and 5 million tons of green hydrogen. That's the minimum amount that experts are talking about, but the numbers could well be higher if you add enabling infrastructure, transport infrastructure, storage infrastructure. So one of the key issues that was highlighted in the previous workshops, that whilst the banks and lenders and equity investors have all very well understood the market risks, but the capacity is just not there. So really an open-ended question to all of you from your experiences. Do you concur that the financing capacity is not there, or do you think that is not correct and that there's enough money going around? And I say that with the backdrop of conflict around the world, oil prices going high, interest rates going high, inflation going high. So that's the backdrop environment we are operating under. So what is your experiences in terms of visibility of risk capital, equity risk capital? We'll do the detailed discussion on debt in the next workshop, but today let's just focus on equity. So in the same running order, Kishler first, Matt, Rajat, and then Tarun.
So our mandate, which is very broad and covers emerging markets per se, we see some traction happening on the hydrogen side, but in emerging market context, the real challenge coming is the use case of hydrogen, whether it's for indigenous usage within the geography or whether it's export oriented. If it's export oriented, how is the value chain or the transportation angle coming along? So that's from a very infra side, from wearing a VC hat, facing a lot of technologies, use cases of hydrogen coming into place, which we can sort of come as a substitute fuel for some of the things which are happening. So we are trying to just see at our scale, at this level, as an introductory comment, is how the scalability of these businesses with proper offtakes are in shape for us to get that comfort about that equity risk capital going and we have speaker from Avada out there. They are a perfect use case of a promoter trying to make a use case within India. So that's what we are trying to see the landscape. I'll just take a pause here because we are just talking about the landscape right now.
Kishlaya, risks aside, you've identified the risk very rightly so, and so did our colleagues and experts previously. But if I just take from a volume perspective, anywhere from $500 to $600 billion of capital, a third of that is equity. So is there supply side equity available in the order of $200 billion? That's really the question.
I think we'll go back 10, 12 years back when feed-in tariff was happening for renewables and people were saying, where will this money come from? So definitely we all talk, capital is not of sort of the thing here. It's more about the use case of hydrogen in emerging markets and it being established first on a concessional basis, then on a non-concessional basis, and then on a commercial basis is something which risk capital will follow. At this stage, what we are looking for is some opportunities with blended finance, some concessional financing, to make a case that yes, hydrogen is something which emerging markets may like to do in case of India as well. So we also see a little divergence of view when we talk to is whether it's a good strategy to go for indigenization usage or make it more export oriented. So the limited submission here is that if scarcity of capital is not a case and would not be, it will be more of a case of taking that incremental use case of hydrogen and the value chain aspects being holistically considered for money to come along. And just very vividly remember 12, 14 years back when feed-in tariff started in the solar PV and people said, oh, whether this will work or not. So something on a similar line. So capital was never an issue out there.
Great. Thank you. So opening remarks, Kishlaya says, money is not the problem really. Get your use case and business case right and the funding shall follow. Matt, do you concur or sitting in London, I guess you're less of an emerging markets perspective, but generally global money markets, what are they doing? We heard quite sadly all the offshore wind auctions failed in the UK. That unless the cost of energy rises or pricing paid rises by 75%, no bidder, no developers coming forward. So if interest rates go up, do they choke the equity supply as well? Matt, I mean, that's just one sub-question within the larger question.
I haven't done all the maths on how much capital, where does it come from to solve that problem? But yeah, I think I think what Kishlaya said is right. The money's always there for the right things, and at the moment there are a lot of different. There's positives and negatives. So yes, there's a lot less money globally has gone into infrastructure investment this year than the last few years, but it's really a blip based on interest rates. Like every single big, my clients are. Private sector, pension funds, insurance companies, just, private institutional investors. Because of rising interest rates, we've seen a lot of transactions stalled, a lot of inflation across a lot of supply chains. That has upset the relative pricing of lots of different things, be it the cost of equipment or the cost of money. But it's really a blip. It's a 2023 blip. I think you're going to find that that you see that being sorted out now. You see fundraising infrastructure increased. To put some numbers on it, I think in terms of money specifically allocated to what we call the infrastructure investment class, that was getting up to $150 billion a year for years, and this year it's sort of collapsed. But actually, it's rising again right now, and you'd expect that over the next years ahead. You're probably looking at $200 billion a year going into fresh money going into infrastructure. You still meet a lot of quite big LPs around the world that have, particularly in the US or somewhere, 50 investments in real estate funds and 3 investments in infrastructure. So there's still a big, and real estate has not done well in the last few years. Infrastructure as an asset class has proved itself to be very stable and done what it said it would do. So the broader theme is there is a lot more money coming into anything called infrastructure. Inside that theme, anything called renewable energy and anything called energy transition is at the front of that queue. And there are a lot of investors around the world who have been doing this for a long time. I mean, the first German feed-in tariffs was almost 25 years ago. So not everyone's been on this kind of journey that long, but there are some first-time investors, but there's also a lot of quite experienced investors who understand the risks, and it's not feed-in tariff stuff anymore. You use merchant power projects, but those risks, the nature of energy markets being different everywhere, and you having to get a price somewhere, and how that works. There's a big pool of capital understands that. There is occasionally, for political purposes, some obstacles put in the way of renewable energy development here and there, but overwhelmingly around the world, most of the time, there's a lot of supportive legislation, and that push for that continues. So it is a pretty good environment and will attract a lot of capital. And it all then is, as Ghislain said, it all comes down to that use case. The use case is not something we really have to ask much in terms of renewable energy stuff, but you do at some point have to get beyond. They are complex systems you need to grapple with. And at some point, you've built enough solar parks and enough wind farms, you need to do other things. I guess that's what we've been involved with in Britain for a number of years, in the rest of Europe for some time. We're now grappling with that in Australia, which is very particular grid. Every country has its own, is wrestling with the same themes, but the specific details are different. So, the Australian energy grid is a very peculiar beast in some ways, and the vast majority of power on that grid is supplied by coal. So changing that quickly is hard. So I guess the other point is this transition you're talking about, this demand for capital we're talking about in India, it's the same everywhere. So that's really I don't think it's shortage of capital looking for this type of stuff. It's back to the old thing of where do people allocate money, and good, well-regulated places have always worked. But it is. So I think that the sort of challenge you're facing in India is similar to elsewhere. I mean, you're trying to attract foreign capital into Europe as well. A lot of investors want to invest in America right now. The incentives there are huge. That's just a specific thing. But the way to really do it is to acknowledge that costs have gone up. Everything costs more. Even the supportive regulation, like in the UK, they're trying to support offshore wind development. They just got the numbers wrong. That will sort itself out. You see the head of Macquarie calling for that globally yesterday. I mean, if you want offshore wind farms, you just have to pay more. It's still pretty cheap power. It's still what's needed. We're developing, we're supporting developers in different parts of Europe, developing reserve power, batteries, solar, wind, geothermal, and developing some of our own more complex energy transition assets in different places. The development case for all those, the cost of what it's going to cost to build all of those things has gone up, but they all still make sense. They all still, they all still make sense. They all still look good. They also look good. The cost of other types of infrastructure has gone up as well. I'm not sure it's a shortage of money. It all comes down to detailed things, right regulation, and ultimately broader macro things slightly beyond the scope of this discussion, perhaps, of just a stable currency and that sound policies. That's really what people need to get over. To be a lot of the capital you can attract in India will be capital for the first time. For the Brookfield that's backed Raj's company, you need 50 of those to raise money and commit. That's the sort of challenge.
And that's essentially my underlying question. Are there enough 50 Brookfields out there, or do we need to create more, right? And we'll come to that point during the discussion. And I want to eke out that particular issue. So for tier one developers, one of the comments that I'm hearing from the industry is concentration risk, right? And perhaps Rajat can answer that when he comes in. But essentially, Matthew's saying, much like Ghislain, get the business case right, get the environment right, and money's not a problem. Money's quite fluid and fungible. It'll go to Australia if it has to, and go to India if it has to, but get the right right messaging, the right incentive structures. And I want to also discuss, so perhaps my speakers can all start thinking about what is the risk-adjusted returns that the investors would accept now, given interest rates in the US, UK, Europe are high, right? But the infrastructure asset class is not providing the returns. The returns are akin to cost of money being next to zero, right? So, and that's why this wind auction has failed. But Matt, you say it's a blip, it's a temporary blip, but in 2 years, a lot of dry powder will accumulate, right? And if you don't deploy that money somewhere, right? Yeah, with inflation being high, you're actually losing money. So is this the moment for emerging markets, which are offering 8, 9, 10% return on the dollar, to start attracting more capital? So again, this is another question that I want you guys to think about. But Rajat, Avada has just concluded with Brookfield. So just talk us through. I mean, Brookfield's not new entrant in the market. They're pretty well exposed. They understand the risks over the last few decades. But the underlying macro and micro risks remain the same. Did you see any difference in their approach when they were discussing with you? What are the issues they raised? How did they get so excited? And will that excitement remain? And as the question was raised, are there 30 of those Brookfields that India needs available? Right, one Brookfield alone won't cut it. So, Rajat, your experience of
so basically, look, our view is that, first of all, I concur with my other colleagues that capital is available definitely, and there's a lot of capital which is sort of fence-sitter to enter the infrastructure sector. Okay, and I can say it's more so with India. Having worked in this renewable sector for the last 12, 13 years in India itself. Okay, this is my third platform. On the RE side. All right. So capital is available. All right. I think the issue is that, of putting the right business model in place, the risk and reward metrics to be balanced out. All right. So the sector is definitely evolving. So when we look at from a Brookfield perspective, Avada is already an established player, right? I'm saying they had a 4 gigawatt of operation capacity when Brookfield came in, and there's an established track record of having created the assets in the past and, made a significant higher exit earlier, right? From that perspective, we were not a fresher in this sector. We were a well-established player, and we were trying to leverage our renewable energy platform to go for a backward and a forward integration, right? Okay, that's make it much easier for an investor like Brookfield to come in and, invest, right? And definitely they have given us a growth capital, not only for our RE projects, but they have come in for our model manufacturing as well for the green hydrogen ammonia ventures as well. So they have come at a group level. The other point is, so I'm saying the capital is available, definitely. The type of capital we are looking at, is that available in that quantum? Probably not, okay? There are people who are sitting on the fence who will keep coming as and when this sector gets evolved. There's some clarity emerges, especially on the offtake. All right, while about a year back, we were hearing a lot of discussions where people even talk about technology issues, etc. But I think gradually people are, while that's an issue itself, people want an clear answer. But still, I think it's basically coming down to an offtake. All right, from a business model perspective. Okay, we were also waiting for the regulatory clarity to emerge from various governments, whether in India or even Japan, Korea, or European Union, for example, in terms of what sort of concession subsidies they're willing to offer to their off-takers. So point is that capital is available. It may not be available in that abundance. It's a limited capital could be available today, but the way we are looking at this, a lot of talk and discussions happening. We believe that over the next couple of years, a lot of things will get evolved, a lot of clarity will emerge, and therefore much more capital would be available. All right. And I'm saying this in context of green hydrogen ammonia. I'm not talking about overall as a RE sector per se. This comment is more with respect to green hydrogen ammonia, because I think for rest of the other, things are well established, business models, they're clear, the risk reward and the return portfolio and profile is available. So I think it's more for green hydrogen ammonia where directionally people believe, yes, this is the way the things will move in future. But still, some of the commercials and those return ratios are not yet well established, right? They're still evolving.
Great, Rajat. So thank you for your introductory remarks. And like the previous two speakers, you've also said capital is not an issue, provided the right business case is established. Green ammonia, of course, is part of the energy transition journey that India has to adopt and is adopting. But I think I'll pick on that particular point that you said, maybe not the kind of capital that's needed. Maybe that much is not. Quantum is still an issue, and I want to carry on poking that particular subject. And I say that because why are we doing the workshops in the first place? The government wants to know where are the bottlenecks, not the bottlenecks just for here and now, but also the bottlenecks for tomorrow. So as the government puts its ambitious target of 5 million tons of green hydrogen, you need also significant RE capacity and round-the-clock power capacity to come online simultaneously. So large amounts of capital would be required. So thank you, Rajat, for your opening remarks. Tarun?
Well, I think the money is an aspirational figure here. So definitely this kind of capital is not available. More so in the sector where, as all my earlier panelists have mentioned, there are concerns in terms of establishing the user case. So given all that, given it's a new sector, which ideally should be benefiting from venture capital, startup capital before moving into institutional equity, here we are learning to run as we are learning to walk. So I think that's the dilemma. But having said that, there is also a concern on the global macros, given the heightened risk perception. So as you I think briefly alluded to earlier, in the last 12 to 18 months, the expectations on equity has gone up by at least a couple of 100 bips, if not more. And should the current volatile environment continue, I'm not sure what will be the risk-adjusted return on capital on sectors such as these. So I think there are these multitude of factors which obviously will play out in the next 6 to 12 months. We are hoping, given the support that this specific sector is getting from across the board, governments are bending over backwards to essentially provide whatever fiscal support, whether it's the central government, the state governments, how they can, in a way, address the risk perceptions before we essentially establish the first few user cases. That may come to benefit or aid, I think, equity capital providers to an extent. But I mean, we are all optimists. We are hopeful things will pan out. Things will probably play out in favor of this sector moving ahead and contributing to the energy transition story.
Thank you, Tarun, for confirming the point that I started the very discussion with, which is maybe not the amount of capital that's needed. That still remains a question mark. So all four of you have said that, look, capital per se is a non-issue. Quantum of it may be, but get the business case right. Now, getting the business case right also requires significant amount of capital, right? We still could not, we ran a carbon finance workshop. So ultimately, who pays for the energy transition. That very molecule of green hydrogen is more expensive than gray hydrogen, right? So everyone's eagerly awaiting on mandates to come in, but I think we can all be fairly confident that the mandates would not be 5 million tons. The mandates would be a lot less, right? And will those be enough to make the markets? We've had issues regarding compliances with previous mandates. So how stringent would those mandates be is a wait and watch. Matt alluded to the Inflation Reduction Act in the US. US is pulling in a lot of money as a result. So would India be able to offer those attractive returns? So the global macro definitely will have a point to make. So let me just shift the narrative a little bit on what the risk-adjusted returns should be. And if I paint a picture, 10-year US money is at 5, or UK is at 5.5%. 10-year Indian money, probably 300 basis points more, 200 basis points more. So the delta between a market risk in India and a market risk in UK or US has definitely come down, right? Has the wholesale rate increased in India as much as that it has elsewhere in the world? Probably not. A point was made that equity investors are looking for 200 basis points more, but given the cost of money that has risen temporarily as it may be, 200 basis points more is not a huge amount in that sense. So what is the risk-adjusted return that the Indian market can command, and would the investors be happy with that? So perhaps Rajat, if you could come in on that, because you're probably closest to offering that to the investors.
The type of returns investors are looking in. What my sense is, I'm not talking this from an Avada perspective, okay? I'm saying in general, what I have seen is that I think typically investors want to look at anywhere between 12 to 15%, and these are the sort of dollar returns. I feel so, okay, which the investors definitely want to look at.
Raja, 12 to 15 on dollar or rupee?
Dollar returns, I guess I'm saying,
and that's recent. It was not the case 2 years ago or 18 months ago.
So I think even I'm saying when I say these returns, I'm saying based on my experience over the last 5-7 years, I'm saying definitely investors looking at something. I'm not talking about the hurdle rate per se, but I'm saying that typical idle returns, 12-13% was definitely a benchmark for investors to look at a dollar return. All right, okay. Especially considering that Indian currency has always been depreciating, right? Okay, and I think 12 to 15 is a reasonable range. Of course, these returns can vary. They can go as low as 10%, maybe as high as 17%. But 12 to 15 is something which I believe is a median range in which the investors look at in terms of returns.
And these are levered returns, I take it, right?
So I'm saying these are the returns which an investor look at from an equity perspective. I'm saying, and definitely for these become levered returns, but from an investor perspective, this what he gets on is every dollar invested in India.
Okay, 1,200 basis points on the dollar. Matt, what's your experience of delivering the returns in UK and Europe?
Yeah, they're interesting numbers, and I think the main point there at the beginning was that the premium, speaking in the most general sense, the premium an investor would require in India compared to those markets is less than it was. Yeah, I think that's right. I mean, if returns are up, 200 basis points, that's pretty small. Like returns in Europe are up 300 or more. And obviously no one managing assets and valuing assets wants to admit that. And you see a lot of back and forth now, but on valuations and discussions and things. But actually, the things that we used to get very basic, to go back to sort of more basic mass market of renewables, things that you would get 7% or less in France, Germany, the most low cost markets, they're on 9 to 10, quite comfortably. It's very hard to pin it down, though. I guess is the point. Is even in a more established market like renewables, it's very hard to pin it down. The amount of transaction activity has collapsed. Like in any falling market, people selling don't want to sell before they have to. They don't want to acknowledge that their asset is worth less than it was. So, but in terms of new build stuff that we're starting to see now in activity, I'd say easily in euros you're up 3%, in sterling 2.5% or more. So that's in very generic markets of just, solar parks and wind farms are all the same. But it's that process of price discovery is still struggling a bit. There's just a lot less transaction volume than there was. So that's all a bit indicative. What does it mean for, say, newer things like hydrogen? That's even harder to pin down. Like we're developing hydrogen projects and building hydrogen projects in Germany. We're doing it in the UK. The obstacles there are, it's a little bit about policy, but mostly it's just about getting kit. We just get called by people and say, you've been waiting 2 years for your, transformers or there's all this kind of quite specialist design kit for very big projects. The people making that have got years and years of order book waiting, and they just call up and say, you need to put down a deposit now, otherwise you just to the back of the queue. I'm sorry, it's just costs have gone up. So that supply chain of just getting stuff done is the hardest part, and that is particularly hard in Europe when a lot of stuff is not made, even by European companies. The Siemens and all these other people. A lot of it is not made in Europe, so that's a particular problem. Maybe it goes with the situation in India might be different. I mean, it was mentioned before, sort of trying to vertically integrate. Start with simple things like solar panels and make those locally. A lot of hydrogen projects will be the use case will be making hydrogen and selling it where it's made. Those are the more sensible cases to get up and running. Even then, the obstacle is mostly getting the equipment right now. So if you've got a viable project and you can get the equipment, you're in a good. So if that's locally sourced, you're in a much better place. So, what is the return required on a generic hydrogen project in Europe or the UK? Too hard to tell right now, but it's mid-teens or higher is honestly what you would expect. Obviously, depends who's your off-taker, what's the project, can you actually get the equipment? But that's where we'd be.
Thank you, Matt. So mid-teens on hydrogen, slightly lower for a well-accepted asset class of renewable energy. Rajat mentioned 12 to 15 on the dollar in India. Kishlea, Tarun, your feedback or comments on this particular aspect. What are you seeing this? And Kishlea, you're an LP as well. Is that too high? But from a development finance perspective, you said we need blended finance. Would you settle down for a lower return? More than the incentives, if the government puts a bankable off-taker in the middle, a market maker as we call it, right? Would there be a shift in the expectation? So if there's a 10-year offtake available, right, from a tier one entity, AAA rated with enough of the sovereign backstop, would your expectation be?
No,
right?
absolutely, Sanmit. I know market maker kind of a concept is very close to your heart, and I know you have been propagating this for quite a while, and I completely support it in terms of need for such entities. But see, just stepping back from an equity perspective, while my understanding is pretty much consistent to what Rajat and Matt did allude to earlier, I think a couple of points. Firstly, this will have to be looked at very unconventionally. This can't be just conventional equity, right? I mean, the kind of numbers that you threw in terms of $200 billion, even if it's half of it or 1/4 of that figure, I mean, these institutional equity investors, whoever are going to write big checks, what kind of an investment horizon will they have? I mean, if typically it's 5 to 7 years, of which 2 to 3 years go in just achieving the operationalization of assets, what's the kind of window available to them to make returns? And therefore, are you looking at conventional equity structures, or are you looking at some unconventional structured kind of solutions to get that kind of returns? And naturally, what kind of exits would be available to these equity players if at the end of 5 to 7 years they need to roll this over to somebody else who is the next man standing in the queue, who will take this $50 billion of pie and run around with it? So I think those are also issues which needs to be addressed and maybe a constraining factor when even approaching this through a traditional lens. And I think that's where, all of us as infrastructure practitioners would have to think through and brainstorm as to what is it that we can bring to the table to help this sector essentially, as I mentioned earlier, not only walk but also start running from day one.
Tarun, thank you. You actually put the summary statement right in the middle. And if you look at the brief of this workshop, is what are those structures to unlock churn capital, right? And that's what the government's asking us, right? Guys, tell us 5 years ahead what happens then, and how do you make this particular market? I'm not saying market maker in terms of how do you provide the necessary foundation that investors who have only a 5-7 year horizon see the visibility of the exit structures, right? So we're back to that churning of capital question. So what are those structures? So InvITs have started. Yes, there are certain early teething problems, like with any structure. People rush in and then they realize could have done this better and could have done that better. But by and large, a yieldco model, which, as we know, the InvIT structure in India is fairly well established. Matt, would you say the fact that infrastructure asset class in the Western world, in the developed world, got the necessary kicker because the asset liability mismatch, which the pension and insurance funds are looking for, was adequately matched? So long dated assets, but stable returns and guaranteed returns. And because there was visibility of this ultimate capital pool, private equity and lenders were a little bit more comfortable that there is someone to flip the asset over to. India's just about to started its journey in developing the yieldco end of the market segment. So, Matt, would you say that's essential for the market to develop?
Yes, a sort of a cautious yes. I think it is, and so that there's certainly there's different types of capital required along the way, and that's true. And because we manage a whole bunch of different funds that do different things, so we do some VC stuff, we do some development capital with smaller developers. In the moment we're doing basically growth capital or development finance for hydrogen developers in the same way that we would have done a decade ago with renewable energy developers. A lot of renewable energy developers that we worked with then don't need our help anymore because they've got much bigger, but hydrogen's a new thing, so you're sort of starting again. And you see now that so eventually you need something, whether it's called infrastructure or not, whether it's called yieldco, these assets should look, in a lot of instances, a lot like other infrastructure assets. I mean, once you've got a green hydrogen project that's up and running and you've got a customer with some kind of offtake, it doesn't need to be fixed price, doesn't need to be forever. You've got a customer buying product off an established thing that just works. Then, it doesn't look, a lot of the technology at that point is not that complicated. All your supply chain risks that you've got now, all the development risks of new things, all the regulatory concern of how's this going to work, all of that will be behind you. So, I don't think you're going to struggle for people to buy operating assets when they're operating, if they've got offtake. Some of them will have good off-takers, some of them will remain as merchant, trading things. But if it's just selling hydrogen locally to a customer under some kind of contract and it's already working, capital will be there for that. That does not look that and capital will form, whether it's a yieldco, whether it's listed, whether it's called an infrastructure fund or not. I mean, we've been through so many iterations of that in different places. I mean, there's 50 infrastructure and renewable energy yieldcos in London. That was a few years ago was a great success story. At the moment, they're all struggling a bit. So, and different types of institutional investors have been very big on infrastructure and renewable energy at times, and now they're out. Some are in. So it does vary. It does move around a bit, and I think it would be the same for hydrogen over time. And you can sort of see that journey a little bit. I mean, we've had, if you look globally, there are hydrogen VC funds, and then there's some more hydrogen growth funds. And, we're looking to raise a hydrogen infrastructure fund because that's the next step. But it's not a hydrogen infrastructure fund as a core yieldco yet. It's a fund that necessarily needs to do development and construction work on hydrogen projects. That's the whole point. They're not there yet. So you can't. But, when the time comes, when a lot of them are built and get through this quite tricky phase of how can you get enough equipment, who can provide you enough equipment on time, and what's the cost of capital, and how do you get all up and running? In years to come, when those projects are running, there will be people to own them in the future. But yeah, I think that's, so whether that's the same funds that own renewable energy assets now, whether it's different, we'll see. But arranging that capital, if it was there now, it would be easier for people financing projects, for sure. I'd be sure. I think that funding will be there though, one way or another.
Fundamental question here. Will production of green hydrogen or ammonia be classified as an infrastructure play, or given it's a chemicals output, is this truly a hybrid between infrastructure and manufacturing? I mean, we need to be aligned on the taxonomy of this entire thing. If we really need some big amount of capital coming in this space.
Yeah.
And Tarun, I was just asked this question by the official from the ministry 2 hours ago, right? That classification of green hydrogen.
You're not saying that the bureaucrats think alike, whether national or international.
No. So they're asking this question: if we classify green hydrogen as infrastructure priority sector, right? Would it?
But you are referring. Sorry, hi. This is Rajat. Are you referring in context of market being infrastructure or priority sector? How you are looking at it?
No. So the question to me was, and I didn't have the answer readily, is if the hydrogen project, green hydrogen, is put in the infrastructure category, right? Which I think it is, but I think they're asking more from how Reserve Bank of India classifies it.
So I think I'd like to chip in, because based upon our discussions at various industry forums, etc., I'm saying, the way we look at it, it is not just a manufacturing thing. Because the way it is coming is towards us sustainability, part of sustainability, and environmental, perspective, and it's very much going to replace a lot of future energy requirements, all right? And the way we are looking at it from banking perspective also, unless until it's classified as a priority and an infrastructure sector, apart from the risk capital, there will be a lot of debt capital is also required for the same. Okay. So, and based upon our discussions with the MNRE, etc., I'm saying where it seems the government is keenly looking at, or possibly looking at, and evaluating whether this can be really classified as infrastructure and a priority sector, because then it moves the needle a lot from a financing, from other regulatory and compliance requirement as well. So as one of the developers, we feel strongly that it has to be an infrastructure and a priority sector classified.
And Rajat, what would be the cost of money differential if it was?
So I think the cost of money differential, I really can't put a number, but I think it could be anywhere between, from a financing perspective, it go down by 150 basis points, 200 basis points. But more than that, the quantum of funds that would be available goes significantly high, number one. All right.
Yeah.
it definitely offers a lot of flexibility in terms of capital structuring of the projects. Okay. And I don't want to go into nitty-gritty of those structures herein, but the moment you classify it as an infrastructure sector, the moment you classify it as a priority sector, even under the Indian Companies Act, under the Income Tax Acts, etc., a lot of things you can do differentially. Okay, even from bringing the foreign capital, it opens doors under the FVCI regulations. The moment it's classified as an infrastructure sector. All right. Okay. Apart from our FDI perspective, okay, the flexibilities which are available in those structures are far, far higher and superior than if it is not infrastructure sector. All right. And definitely the compliance requirements and even the local banks, the capital or the money which they can lend to this sector substantially increases the moment it's classified as infrastructure sector.
That's the way the thought process is. But again, it's from a debt perspective. My question was more in terms of how does it play internationally when you're looking at raising equity? Now, if, would they be dedicated funds like what Matt alluded to earlier in terms of hydrogen funds? Now, who are the kind of investors in those funds? Are they necessarily infrastructure players? Are they necessarily insurance and pension? Or are they a different set of players? Because if your underlying contracts for GA productions are not going to be more than 7 to 10 years, then what's the merit in having an insurance player backing up and contributing large amounts of equity? So that's where I was coming from.
No, it's a good question, and so speaking that more general sense of not sort of the regulation necessarily in any one place, but what is it as an investment? Yeah, to me, they look like infrastructure investments. I guess that what I say is the heavy capex assets, they're very low cost. I mean, our projects in Germany and possibly in the UK, it's not just that it's all green power, and green power, we hope, is going to be cheap. In a lot of Europe, you have negative power prices often. So our power is free often. So you certainly have an asset that's got it's very high capex, it's very low opex, it's a very high operating margin asset with not much going on. Having an electrolyzer working is not difficult. It does, as you say, all come down to the offtake. And you're not going to get someone. Well, I don't think that the market's going to develop that you're going to get 20-year contracts with someone. But honestly, in most of the world, there are not 20-year PPAs for power either. Though most renewable energy power in the future will be sold on a merchant basis. There's not going to be PPAs covering everything or government support covering everything. So there are some residual risks. It's not a perfect contracted core infrastructure asset like a 30-year government concession or something. But I think it still fits well within what you would call an infrastructure asset for sure. And the other, I guess, aspect of that, which sort of informs what you hope that position is reinforced by regulation in one place or another. I guess that's the other part of this, is it's not just about generating, from a government perspective, from a regulatory perspective, they shouldn't be thinking of this as just hydrogen is just a product that some industries, some use cases need. I mean, hydrogen is also part of the energy system. I mean, it's storage for the energy system. That's the big question in energy, is where do we put all this excess power? Like, we do have negative power. I mean, you could reform the way European power markets work, but having negative power prices every time the wind blows is not helping anyone. If all of that excess capacity goes into making hydrogen at the right time, where there's use cases, it has a double role. It's helping the energy system as well. So certainly see it as infrastructure, but time will tell. Come back to me in a year and tell me if we've raised our hydrogen fund. I guess what I would say on that, though, is when speaking to investors, everyone is interested in having a meeting. Everyone's heard of this hydrogen thing. Everyone wants to talk about it. Now, there's a big difference from hearing an interesting story from an interesting manager and actually giving us some money. But everyone wants to hear the story. But where there is most interest is from investors in those countries where the government is very supportive from a policy perspective. The Middle East, Japan, Korea, Germany, places where governments have heavy industry, they know that they have to get off gas, sort of from an energy security perspective, from a political perspective, as well as decarbonisation perspective. So in private and public institutions from those type of countries.
Great. Arun, answers your question? I guess the answer is yes.
Just to add to what Matt was saying, from our perspective, when we are doing this mapping of hydrogen and why we classify more as infrastructure is the given use cases of per se of how it goes. And Matt alluded to a strong policy support, and we are doing an assessment of Korea of how they are getting now hydrogen buses and hydrogen entire infrastructure in place for public transportation. So broadly, how we see that more like an infrastructure asset class. And one thing which we also sort of underrate as what we are still doing an assessment is from an infra side, how big a role hydrogen can play in transportation sector. Of course, not necessarily in context of India at this point of time, but yes, the use cases emerging out of transportation can also make a very strong visible case in the public eyes of where hydrogen is coming through. So just wanted to add that.
Spend a minute or two on the point that all of you mentioned, the importance of hydrogen as in the energy security context. If it does play that role, critical role in energy security, in smoothing the markets, the lumpiness, the intermittency of renewable energy, when curtailment happens, Matt, you alluded to that. Can that excess power be used to create more hydrogen? And thereby you take the volatility, hopefully in the long run, volatility out of the power markets. Who pays that premium?
Yeah, well, it depends. Hydrogen then becomes part of the mix of all the things that someone trying to regulate an energy sector already has, and it's already complicated and difficult, and everything. But it becomes just becomes part of that mix, because at the moment the cost of capital for projects is higher, because now when you're building renewable energy projects, you don't have a feed-in tariff for 20 years. You just have negative power prices or variable power prices, and that's an issue that's not been that widely it's maybe not as widely discussed as it should be in Europe, because of the last 2 years there's been a big power price surge, and that everyone with renewable or wind in southern Europe or central Europe has benefited. But that's falling away, and now the fact that on windy days there's negative power prices, there's a market design question that needs to be addressed to continue to attract the amount of capital needed, and that's a question that will come up in most markets as you have more and more renewables. So I'm not sure it's sort of paying a premium, but I think hydrogen it's part of the answer in a way, and if you get it right, the benefit of that is it's part of the answer for the energy sector, but it also means that the local production of hydrogen can be cheaper than it otherwise would be. It doesn't have to be made in sunny places or windy places. It'll just be made locally wherever, and it's helping out the energy system, and then it's cheaper. And then if it's cheaper, more use cases might work. Like those questions there, like on transport or stuff. I mean, when we own some, just as one example, we sell gas to CNG to trucks in the UK. Eventually, we hope that those trucks might be on hydrogen, but it's impossible to do the numbers now. You can't even buy a hydrogen truck. We own a ferry business that's running completely on diesel, and everyone, we're trying to figure out how to decarbonize that, but trying to figure out whether should it be a battery ferry or an LNG ferry or a methanol ferry or a CNG ferry or a hydrogen ferry or an ammonia. You could spend a year speaking to a lot of people. No one can tell you. And then when you land on something and say, I'd like a battery ferry, then you find that you can't get enough power to the dock, and it's going to take you 4 years before someone can give you a boat anyway. So, but the specific use cases are very hard to work through and will evolve over time. But if hydrogen is seen as a useful commodity itself, but also part of helping the energy system be managed better, then it sort of makes the best of both worlds. And you might get slightly more hydrogen use cases than you otherwise would.
So thank you for bringing out those nuances that, and I guess the answer then is you can't just put equity in the same bucket. It's what's the use case the equity is trying to fund will determine what's the risk it's trying to address, and therefore the return expectation would be very different. So if it's a venture risk, you're trying to take on both the technology performance, the technology availability risk, more so than the project risk, right? And therefore would demand a much higher return on equity capital deployed. Whereas if it's a stable utilization of the technology in a project context, the returns would be slightly different, right? So it's also the use case also determines what kind of capital are you looking at? Can I just bring Rajat into the mix? Rajat, from your perspective, where do you see bigger demand coming from to deploy the capital? Is it from the LPs and the sovereigns coming in directly? Is it still more private equity like Brookfield? Is it more industrial groups, the big energy players? Where are you seeing the demand coming from to deploy capital?
So I think it could be a combination of all, right? So far, we have been having some discussions with of course, apart from private equity investors, a couple of discussions we have with sovereign investors as well, and large industrial players, especially in offshore markets, right? So there seems to be a lot of traction and interest, right? And we don't see that as a challenge, right? Again, I think the first comment we made, all of us made, was with respect to putting the business model in place. But in terms of traction, we see whole spectrum of large investors, okay, who are willing to look at this sector per se, all right, and especially even the players who can be potential off-takers, right, are willing to look at partnering, as investors as well. So we really see a lot of excitement and interest in the sector per se. Okay, but again, it's very evolving, considering that there's so many moving pieces to the whole puzzle right now.
Got it. Thanks. So at this point, we've got about 45 odd minutes left. We had an interesting discussion. Let's open it up to the audience in the room. If you want to ask a question verbally or put it in the chat box, please feel free to do so. I already see a comment from Steve from ADB. Steve, glad the point on energy security that you made a few weeks ago has come up again. But who pays that premium is still to be determined. But Steve, you've got a comment. Why don't you perhaps ask the panel members the question directly or address that comment directly?
There's a lot of new funds coming up across the board. And I think the challenge with hydrogen is seen as somewhat niche and almost boutique and a little bit politely, but it's not seen as something that's normal. But in fact, it's actually an essential part of decarbonisation. So if you were looking at a range of projects, and some of these projects may be, multi-gigawatt solar installations that are applying to decarbonize to electrolyzers going off to chemical industries or going off to export or to steel, then there may be smaller facilities that might be parasitic to a particular industry, whether it's cement or steel, where it makes a lot of sense, or it could be actually really very small scale agricultural or municipal waste type projects going to hydrogen, and then to a distributed model and to a distributed connection model. Well, they're all different types of projects. The first one's infrastructure, the second one's energy efficiency, and the third one is distributed energy. So having a fund that would be able to look at decarbonisation would be a very, very good idea. And in fact, we're doing some work at the moment on trying to understand how we might look at decarbonisation, whether reviewed as supporting it through existing funds and whether an additional fund is needed. Now, that's probably 2 years away. So that's not going to help things in the short term. But my question would be, do you see any industry interests, for instance, from insurance companies you mentioned earlier on, or some of the large investors, about how they may be able to more effectively deploy their capital to this problem? And Matt, I'll take the example of the ferries. You want to spend a year wandering around talking to people. Well, if you have a fund which actually has tools that make it very easy for them to quantify what the particular technology will do in a way that is useful to operators and also to funders, that would be particularly useful. And in fact, we're hoping to do some work on steel, cement, fertilizer, marine transport, i.e. ferries, and aviation, that would provide a decisional tool which would be supportive of such a fund. So I think it's a matter of trying to tie all the ends up. But I'd be interested to hear the view from the finance community, who we've got a very good representation of here today, about what they see of funds going in that direction or taking that direction. Because the MDBs can provide a bit of support and tie it together and, could actually take a first loss for a portion of it. But I think it does need a wider effort on decarbonisation, like we've seen with the Global Environment Fund or the Global Climate Fund. That's my bit.
No, Steve, I think that's a very noble idea in terms of pursuing this. It also is a good it brings the mobilization angle as well as de-risk through the structure and prioritizing the various things. We are also working on similar lines to see of how we can create separate waterfalls for various investor appetites, and also try to see more strategic things which we can do. So couldn't agree more on it in terms of what you said. It is that it has to be the real like-minded MDB has to mobilize more private capital also along with them to really see that it's a win-win for both public as private money coming along. So couldn't agree more on it.
No, likewise, I don't have anything further to add. But in terms of credit enhancements and use of first loss structures, my limited experience has been that these are nice, novel instruments, but only for the first few projects in the queue. I have not seen these credit enhancement structures being replicated to, scale up investment volumes. So it's only the first few projects which may benefit from this, with the attendant objective that the risk perception will come down and crowd in other capital.
The danger, Tarun, is if you kind of get hooked on those credit guarantee instruments and enhancement instruments, you don't get nearer to a market equilibrium, right? Because this would not be a forever capital, right? So the first loss instruments there's only a limited set, as you say. The first few projects is fine, but what happens beyond that? And that's the whole point that we're discussing. That how do we ensure the market? And I think Kishlea mentioned that from initial concessionality to commerciality end of the spectrum. How do we move across? And again, a question to the panel, that the earlier projects, of course, would be risky, but we've all identified that hydrogen requires slightly different thinking, slightly stitched up thinking, joined up thinking. It is not as simple as just putting a solar asset, because it plays very, very different roles in very, very different sectors. So everyone has to kind of educate, but developing the markets so that there's depth in that equity money availability will come from those strategic structures that we are alluding to putting along the way. So again, the question then is, should I, and as Steve mentioned, should our focus go on boutique, niche type, horses for courses, highly bespoke structures, or should we just carry on as is and leave the market to its own devices to find the pathways and the fund vehicles to deploy capital? So anyone, whoever wants to take that question.
One observation here, Samit, is that what we are seeing in hydrogen space is platform strategies taking shape. So you start with small, you get a founder, you get a small offtake, you prove it, and then you try to make more use case, grow that use case of what you have already done, as well as capture new. So platform strategies are something which we are trying to see if we can incubate with people who have the technology, the people who have the foresight of seeing of how the hydrogen has evolved in the Western world and can come to emerging space. So one thing which we are observing just on that bit.
So more niche, more targeted, more focus. Kishle, that's your answer.
And starting small, starting doing and then scaling.
But then it does not stack up in the hard to abate sector if you're talking of supplying hydrogen to refineries, right? You need large projects, right? So
somewhere it has to start. Somewhere it has to start. So the point is that somewhere it has to start for investors to put money, get their money back in a form and manner which they are comfortable with, and then grow that business line deeper as well as grow new business lines.
Here. Very good point.
Yeah. I would say I would just add. I think that's right, and there's the way that will play out in different places is different. I guess as Steve pointed out at the beginning, there's, I guess we saw saying before in terms of what is the cost of capital. Pretty much every solar park you see is much the same thing. They're all selling power to grid, and you might contract a bit of it or not, but there's a variety there, but it's not much. Hydrogen projects, you'll have vastly different scales, quite different equipment types, very different people buying the power off you. So as a generic sector, it's not going to be quite so homogenous. And that's something we think about a lot. I mean, if it was going to be a whole series of small projects, we might just try and finance some hydrogen projects in our energy transition funds. Our energy transition funds are just, a few years before they were just called renewable energy funds, and then they do slightly different assets. We're looking to raise money specifically for hydrogen because we think in certain parts of the world, it'll be a big enough opportunity set that, you can sell a story to investors that this makes sense. That is not saying we think the whole world is going to be run on hydrogen. If it ends up being 5% of the world's power, that's amazing. Or 3% of the world's power, that's a huge thing, even then. So we there's a lot of use cases get spoken about, a lot of projects people talk about that don't seem to stack up to us. So we do have to filter through all of that as well until it's possible. And I guess that's the same for development banks. If you've got a certain amount of capital and a certain amount of time to focus those incentives on the project, it's just a harder challenge. Financing the first few wind farms was great, and then people will go off and do lots of wind farms. Financing the first few hydrogen projects, you sort of have to just be careful to support the ones that need support and that look like they'll be a good case. Whereas say the contrast to that would be like the IRA. I mean, you go to America and you speak to a lot of my peers and much bigger fund managers than I am, and they'll say, we were going to do all these projects in Texas and Wyoming anyway. We were going to get 9%, 10%, whatever. Now the IRA gives us an extra 3%, but we were going to do them anyway. That's basically what they tell you. So, that is very, grossly inefficient, obviously, and distorts a lot of things. And so you might, so as projects come along, which ones to support, which ones to back is a more complex question than it might be with just generic renewables.
No, I think it's not simply, which project to support, and it goes a bit beyond. I'm saying it's something which is fundamental or systemic to the whole sector per se. It's the question which one initially asked, that who pays for the green hydrogen, who pays for the green ammonia, all right? Why should pay somebody a premium for that, right? Okay. Similarly, it is, akin to who finances these projects at what pricing, Okay. So real issue is that while I'm saying we all discuss about it and we talked about the rate of returns which the investors look at, the availability of the risk capital, the availability of the debt capital. But ultimately, if this sector has to be really pushed hard, all right, and if people are, I'm saying when I say people, serious being, it could be government, it could be also multiple stakeholders being serious about pushing for replacement of fossil fuel with the sustainable fuels, then the real questions which you all be asking is that who will fund this capital at what pricing, for example? Will the government steps in, will they offer, because while the capital is available, the question is real at what price it is available. If investors are going to look at 12 to 15% returns, for example, which I talked about, right? And then this really raises a serious issue with respect to giving a thrust to this sector, right? So therefore, it has to be cheap capital, available, because there are fundamental. I think it will take few years to get the sector settled out, evolved, and become more predictable, like what we've seen in the wind and solar energy in last 10 years. All right. So it's a question of who providing the right capital at the right price. While the capital is available, that's a real issue. It's akin to who will buy the green ammonia. When say a blue or a gray ammonia is available cheaper, right? So it's similar to that.
And Rajat, thank you for bringing that out. And that's the fundamental question where we're just skirting around, right? We're not calling out the elephant in the room. All of you are saying if the right business case is there, well, who pays for that business case, right? There's a gentleman who's put a comment that green ammonia is $1,000 a ton, right? Who pays the $400, $500 differential?
Yeah, so basically it's a chicken and egg situation. For example, if I say that, say if the investor is looking at a 15% dollar returns, for example, right? Then take into account the risk return and rewards, into consideration. Somebody will say that we would like to charge an X dollar as a premium to a gray, hydrogen, right? Or blue hydrogen, for example, right? And therefore, then it means that, then who will buy that, at that premium, for example? So ultimately, it's a chicken and egg situation. Therefore, it is not that, fine, the project is viable. Project is viable at a certain cost of capital and a certain pricing. It is not that, fine, if the green hydrogen is being sold at, say $500 or $700 or $300, then this capital is available. No, the answer is there has to be a capital available, all right? And that will also lead to, and therefore there has to be certain, I'm saying it is similar to what government push for RPOs, for example. The off-takers need to meet their RPOs and therefore they have to buy green power, for example, right? Similar to, unless until these people are compelled to off-take green ammonia or green hydrogen, right? Okay. And similarly, the government pushes for a capital availability, right? Okay. So it is from both sides. It cannot be just, the business is viable and therefore the capital is available. It's all things have to come together to make it work.
Exactly. And that's precisely where blended finance comes in. And that was my question to Kishlea, that would you be willing to take a lower return? You're a DFI, and Tarun, same for you. Steve, same for you. Or all of you are looking at the same level of return that a Brookfield is, right? So how do you bring about blended finance to the market, right? And that's really the question we're asking. It's not plain vanilla equity financing. Firstly, money has to come in paying that premium. So governments will initiate those mandates. Rajat, I mentioned in my opening remarks. We don't know yet what those mandates will be, but governments will be very, very careful, right, in not inducing green inflation, right? Because ultimately the energy companies or fertilizer companies will pass that cost down, right? So governments will be very, very mindful of that. So again, and that brings out the question of carbon, right? Who pays the cost of carbon, right? And government's looking at regulating the carbon markets in India as well. So that's coming. So that's a great step forward. So if in one of the workshops we said, if the money was available, now it's debt money. Debt money was available at 6.5%, 7% in rupee terms, not in dollar terms. If renewable power was available at 3.5 rupees a kilowatt hour, round the clock renewable power, not just intermittent solar or wind. So if RTC power is at 3.5 rupees, and if the equity return expectation is about 10 to 11%, the cost differential between green and gray is less than 100 rupees, so less than about $1, right? And that's what's been mentioned. So, and like Rajat mentioned, if everyone comes together and says, look, we're happy to give some concession on return expectation, some concession on cost of capital, some concession on risk, absorbing the risk premium, we can make this market bankable. And that's very much the business case. So everyone has to do their bit. You can't pass the can down the road and say the government absorbs or the market absorbs that risk, because it'll be a non-starter, right? So this is very much the purpose of these workshops, is to identify these particular points. AIIB is looking to support many of these platforms, but how do you bring blended equity finance into the market? Kishle, your remarks before you leave.
I think blended finance is still evolving. While it has so much being done in India, and I'm looking at Tarun, IFC has been a leader of doing so many things out there. It basically boils down of real use case in terms of what the policymakers want, what the market wants, what the sponsors want, and getting along. So from our side, just on a concluding note, we are looking to explore all sort of structures, GP, LP, VC, platform strategies. But the business model is the point, and at least in the Indian context, we are seeing some export-oriented discussions also happening, whether this can be produced here and then exported across. So that's not an immediate solution to what is needed in the Indian market, but yes, at least some production which is of global standards, which makes the transportation infrastructure in place for people to sort of say that this green hydrogen has been produced. And likewise, we're exploring certain things in North Africa as well, given the proximity to the European market and the American market. So some developments have been there. So we're trying to do a bit, but that's how challenging emerging markets, new things are. But the point here is that we also have launched a recent report on the hydrogen, which you may be aware, Samit, from AIB side, and have gone very granular and looking for opportunities to go about pursuing this. So with this, I'll take a pause and thank you all for your time. I'm sorry I have to skip for a meeting now, but then thank you.
Kishle, before you go, so you're saying highly bespoke, look at the low-hanging fruit, and make that business case. And if that's correct, then there is capital available, and AIIB would look to support those funds or those platforms.
Definitely. Yeah. So once this scalability comes next, so the next challenge is scaling up them, but the low-hanging fruit of creating those bespoke models in emerging markets is the immediate call which we are looking for.
Question from Gagan. I know we touched upon this. Gagan, do you want to speak your question out?
Yeah, sure. Thanks, Samit. Yeah, so I was listening, obviously very carefully to a very diverse set of views from folks who are looking at green hydrogen from multiple angles. And this point on USD return expectations, I just wanted to ask whoever can sort of answer this is, because a return expectation at a project level has a certain leverage associated to it, and a return expectation at a project level, at a holdco level or platform level, has higher leverage, arguably. So are we saying this 12 to 15% is at project level, individual project level, or is it like a platform level or holdco level return expectation?
I think ultimately the investors typically would come at the holdco level. I'm saying at the platform level. I'm saying holdco is a long word. I'm saying when you're setting up multiple projects in this sector, investor would typically like to come at the project level. And therefore, it could be a summation of all the projects. I'm saying the return profile for the platform versus a project SPV may not be very different in this case. Okay. Because, I don't see this sector getting leveraged, over next 5-7 years beyond, what leveraging required at the project level. So this is my very preliminary view. But
so Rajat, are you saying there's very little development premium left for if there's not much difference between a project level and a platform level?
No, I'm not saying that. Basically, I'm saying that what is a platform is that, you might be putting multiple projects, depending on the scale and size across different locations. or, for different customers, right? Okay. And therefore you spread your investor coming in. One is at project level versus at platform level, where investors take a holistic view on the risk and try to mitigate this risk, coming at the platform level, right? Okay. That's what I'm simply trying to say. Okay. So I'm saying that the risk you take at the SPV level versus platform levels, and unless until the sector achieves stability, there's not much of a difference, except for the diversity of those projects, right?
No, I tend to agree with you, Rajat. I think project level equities have their own challenges, and therefore, to that extent, equity at platform level is something which would be preferred. The only challenge, and I think this refers to the question which was also earlier raised, whether one should go slow and look at a pilot's results to come out before writing big checks. That's again a very conventional approach. If we need really billions of dollars coming into this space in the next 2 to 3 years, you can't be following this approach. That you basically, give a couple of $1 million and look at a pilot to be successful before you write bigger checks. So I think somewhere, again, an unconventional way to looking at this specific thing needs to be evaluated and considered.
But then, Tarun, again, it goes to that fundamental point. We cannot see energy transition from a prism of classic infrastructure asset. The earth's on fire, right? So if the institutional investors are saying on one side, hey, we want to do more ESG, and on the other side, I still want a 15% return.
Exactly. That's the issue. And these right? projects are quite unlike. I'm sorry, I just jumped in. These projects are quite unlike, the solar and wind projects. There you can take a modular approach, for example, right? Okay, you can scale up in blocks, right? Okay, and which is much different than our green hydrogen ammonia projects, or ethanol projects, because the scale size and the complexity involved, right? Okay, is very different, right? Okay. So it's to me, I think the real issue which I see is that who provides this capital, sustainable capital for sustainable, projects. Okay, and that includes both debt and equity. Okay, because there's similar questions when we talk at the lenders forum. Same thing. I'm saying, we need a clear, firm offtake agreement, certain value, right? Who will provide a firm offtake agreement, right? Okay, so and if every investor puts the developer at the risk, okay, and therefore if the promoter is taking all the risk, which a promoter and entrepreneur will happy to take, right? But then they will also want to have a certain risk reward in their favor, right? So ultimately, we are all going round and round and round, right? Yeah, that's a fact. We should all accept.
Well, that's very much the function of a market maker. So it's not just the return on investment. It makes sense, right? Because without which the party is not starting.
Absolutely. I'm saying our colleague said that, they will be happy to look at blended financing as long as they are bespoke projects, right? You can't have bespoke projects, unless until all things come into picture.
Exactly. And when you look at the last column on the return expectation on the term sheet, right, all the discussions on green go out of the window, right? So, yeah. So ultimately, it's about, I think, if the entire ecosystem and an entire value chain says, look, I'll shave off 50 basis points, 75 basis points, 100 bips from my expectation, right? Then you start to narrow down the delta, right? To bring that bankability and marketability. So I think the answer really all of you are saying is a few high impact projects which would jumpstart the market, establish pricing expectations, address a number of market development risks, right? And give those pricing signals to the investors.
A PPP model, I'm saying, just, something thinking out of the blues, a PPP model, will it work for this sector, for example, right? Okay. All right. Could that be the approach, for doing certain initial projects, where... Yeah. Everybody comes in, chips in, and say, we work it out, right?
Exactly.
Because the potential is human. But I think there's no disconnect right? Okay, everybody would agree in this forum that the potential for this sort of sector is humongous, right?
Yeah.
But how do you have a car, but you don't have wheels? How do you make it run? You don't have petrol, right? So that's the issue.
Yeah. I have a shiny car though. That's
only just one. Well, one point to add there from a different perspectives, is I think there's the other approach taken in some places is to provide more offtake for the next period as the industry tries to get over the chicken and egg scenario, really, to get away from specific projects is to put hydrogen in the gas grid. That works if you've got a gas grid, but I assume that's a discussion you've had at some point in the last few seminars. Whether that works or not, every gas grid regulator everywhere and operator everywhere in the world will make their own decisions on if that's viable or not and to what extent. But yeah, it's not a long-term solution, but it might be an interim for 10 years, 15, 20 years. While
that's why we call it, Matt, that's why we call it energy transition.
Is there a transition? Yeah, it'll take a while. And that's seen by some people in Europe as a way to, to enhance the potential economics of some projects. If you're looking for, but exactly how that works is still not entirely known. What is the price of that? Is that really set some kind of floor price? If that's regulated that way, it could do, but it's early stage, as you say. Time is ticking. You can't spend years pondering it. So that's another approach to provide some kind of backstop demand for project developers.
So the discussions with the government here in India is India saying 5 million tons a year of green hydrogen by 2030, and there's 5 to 6 million of grey hydrogen consumption today. So if we want to displace some of that towards green, can the government underwrite, let's say, 1 million tons, 1.5 million tons, a third of that market to jumpstart, right? And do that over the next 7 or 10 years and give a 10-year offtake, or subsidize the delta between green and grey. So as I said, the differential is right now at about $2 a kilogram. At 1 million tons, that's about 2 billion a year. Can the government subsidize that, right? And issue a long-dated bond, green bond, which is a sovereign bond. So I think there are wholesale instruments, wholesale finance discussions that have to happen for the corporate finance markets to start, right? And that is really what we're all trying to sort of find the answers to. So what is that number? How much should the governments be investing, and where do they find the money? But we have to go to the government with this proposition. Here are 5 projects. Here are 10 projects, right? And this is the ask, because otherwise it's such a nebulous, such a complex question to answer, right? That we would never. We could have this conversation this time next year, and we'll still be having the same dialogue and same discussion in that chicken and egg situation. So thank you, Matt, for those points. There's a couple of questions that I would take before we start to wrap up. The gentleman, Anshuman Swain from the Central Electricity Authority. Anshuman, your question, if I understand correctly, how much of a techno-commercial information would an investor like to have before they can invest, and is there a tool like a technology catalog that gives investors the answer? So the answer, I think, as much information as possible on the techno-commerciality, and depends on what you're trying to fund. Are you trying to fund a technology proving project, or are you trying to fund a commercial energy production project? So, and many of those tools exist, Anshuman, and these will be released in the summit, the Energy Transition Finance Summit at the end of this month. So watch out for those types of tools. So there are a number of decision support systems that people have developed in the last few months. Gagan, you have a follow-up question, and there's a question from Jay Krishna Shankar. Could you ask your questions directly?
Sure, thanks, Sanmit. Yeah, so I just had a quick follow-up on the return expectation bit. So, I just wanted to get a sense on what type of return expectation, USD return expectation premium are we then talking about for green hydrogen versus, renewables, which is much more stable and established. So yeah, just to get a sense on that.
Well, like speaking to the projects that we look at, if I got the question right, it's sort of just relative returns. Yeah, as much as we know now, because it's a changing world. Yeah, in certainly in Europe for renewable energy projects, whether it's construction ready or operating, we think that's gone up a lot, but it's gone up a lot to call it 9% in the sort of big EU countries or the UK. So that would be a long-term hold IRR. Hydrogen, you're in mid-teens. It has to be. It's not purely at this point. It's not purely about specific risk profiles because they vary from project to project. And some of these new hydrogen projects, some of them are pretty straightforward credit, investment cases with existing customers who buy grey hydrogen, who are just buying green hydrogen. It's big, heavy industry offtakes, all good. And some projects have quite a different. In the first place, is more challenging. So the returns are higher because of that. I think so.
So I'm not sure if Gagan's question was that direct, or I just take it that it's a tangential question to the fact that at the end it's a related party transaction. The way the things are panning out from an IPP stable in India, at least on green hydrogen, you're having the same guys who are also moving into green hydrogen. There are two different legal entities. And therefore, I thought, Gagan, what you are referring to is how to prop up returns on green hydrogen businesses to basically suppress the returns on RE. So maybe that's one way for capital to flow in on green hydrogen.
No, thanks for that, but nothing so devious. I just wanted to sort of figure out,
No, but that's a thought. I think it's a very good. I think it's a very good thought. Maybe so it's good. It's good. Rajat has moved. It's not there. This call, but maybe one way would be to ask them to intentionally, lower their expectations on RE and palm off some of the returns to the green hydrogen to get the capital on the green hydrogen side.
No, got it. That's honestly, I was just asking in terms of what's the distance that if we were to say that return expectations on renewables are as low as they can be because it's a mature sector, it's well established. So just wanted to get a sense of how much of a returns distance does green hydrogen have to traverse to get to the same level that investors or equity investors are looking at renewables from.
Well, it took on RE, I think, 10 years the way the returns have shaped up today, in probably in single digits, if I'm not mistaken. For a new sector where the technology, where the entire project is still not, as we have all discussed for the last almost 1.5 hours, I think it would be much longer. I hope I'm proven wrong in terms of the return expectations. And this entire thing about subsidizing this space, I think somewhere the thing will stop. The buck will stop at some point. I think somebody in the regime will probably sit up and take notice and say, hey, what is it that we are doing with this sector? I mean, why one sector and not the other? So from a public policy prism, I think those questions will surface sooner than later. And I think this mad scramble of the regimes across the world to basically subsidize this space is going to stop. But in terms of return expectations coming to where RE is today, I think it's a long while away.
But they're just displaying that thought forward. If you say the mad scramble would have to stop, whilst I agree, but it also, if you take a leaf from other sectors booklet, you don't need permanent subsidy, right? That's really the point. If the government subsidizes a sector like solar was subsidized initially and it took 10 years, now with the benefit of hindsight, benefit of developing that sector and what downstream economic gains the country has to expect or can expect, a few $1 billion here or there would not break the government's balance sheet, right? But a few $1 billion, for instance, in the first 20, 25, 30 projects of high impact can significantly shift the market. And once that market is established, more money would follow. So isn't there a business case to bring a chunk of capital for those 20, 30, 40 projects?
Yeah, so I mean, if it's 30 projects, say even 100,000 tons per annum, you're looking at 3 million tons. 3 million tons of hydrogen, which is, I mean, I'm not sure if it's hydrogen or ammonia. What is the unit that we're talking about? Let's assume it's hydrogen. Let's assume it's hydrogen. So if it's so it's approximately 4 times the equivalence, right? You're talking about what, 10 to 12 million tons of ammonia, which is anyway higher than what the government has said. But even if you say 5 million tons of ammonia, right? I mean, the issue is you're looking at a capex of not less than $10 billion only on the hydrogen part. Leave aside the RE, which itself will be another 40 to 50 gigawatts. And with all kind of fiscal support which is being extended to RE, that also has to be monetized.
Right.
So I think from a systemic level, we're looking at pretty sizable figures. And I think somewhere from again, as a public policy lens, this would be debated now. Whether you scale back that 5 million tons of ammonia back to 1 million ton or 500,000 ton is a different question. But that's where it will begin to pinch. And I think probably it will roll back the amount of support that is expected by us of the regimes, but then the regimes will balk because there are so many competing choices which are angling for the same government support and attention, right? So unless the government in their wisdom decide that this is it and we are going to write a $10 billion check in all forms of subsidy, then maybe that's one solution. But as we discuss, is that the only thing required, or are you really generating green inflation by basically palming off everything to fertilizers and refining going forward? So I think these need to be deliberated a bit more.
Yeah. And the answer lies is not inducing green inflation, not the taxpayer footing the bill, but let's find efficiencies within the current subsidy regime, right? So if $20 billion a year subsidy is given to the fertilizer sector, can we find that, right? So the ammonia that we import, can we displace that, right? The diesel that we import, can we displace that, right? So I think the answer lies at that level, but that's a wholesale finance, macro financing question. But what the governments need to know, what is that quantum? Is that quantum 1 million tons a year you need subsidy, 2 million tons a year you need subsidy for the next 7 years? What is that number, and how do we finance that number? And I don't think that is very difficult to achieve, right? And let us pose that question to the government, right? This is what we need. Now you go look, and that's the benefit we're going to deliver in terms of reducing your import bill, right? It's a no-brainer question, I think, that we should pose to the government. So thank you to all the panel speakers, Matt, Tarun, Rajat and Kishle. Thank you to all 4 of you for very interesting debate and a dialogue. And as we uncovered, the answer is not easy, but the answer is not unachievable either, right? So take it a step at a time. Look at the next ball that's going to be played rather than the 50th over in cricket parlance. And we can definitely find those projects which will not only move the needle, but most importantly establish those benchmarks. And that's essentially the purpose of these discussions and debates. And as we finish the workshops next week and culminate with the summit on 28th and 29th of November, we'll get into project delivery and project execution mode. A number of you have already sent in your projects. which are high impact and require, of course, blended finance and other innovative approaches to channeling the requisite capital. But we'll put out a very structured framework on what are the kinds of projects that many investors are looking, or the government's is looking to execute and implement in the coming years. So watch out this space. And on that note, thank you very much.
Thanks, Sanmit. Thanks, Matt. Thanks, Tarun, Kishlaya, and also Rajat. This is a very interesting discussion, and we look forward to all your participation at the summit. So we look forward to seeing all of you all there. And if you all have any comments, suggestions on the program, ideas you'd like us to implement, please feel free to reach out to Sanmit and myself. So with that, thank you all, and have a wonderful rest of your day.